What's going on, everybody? Stas here. Welcome back to another video. So today we're going to be talking about the top 5 dividend stocks to buy now for 2021, and I want to share with you guys how I'm actually looking to make passive income in 2021, because let's be honest, a lot of people say, oh, YouTube's passive income. Oh, this business right there is passive income. No, this business is passive income. But the truth is, dividend investing is the purest form of passive income. All you have to do is literally buy a stock, that's it. And now you get dividends, you get cash flow for simply owning the stock. So let's dive into this, guys. If you all enjoy the video, hit the like button, subscribe to the channel, and make sure to join the Strive Smart Discord chat, the Facebook group, and get some free stocks. All of those are linked down below. So stock number 1, you see it here on my screen, is ExxonMobil, ticker symbol XOM. And this is a company that is an energy company. It's been hit very hard in 2020, and I believe in these next couple of months, the next year or two, this company and a bunch of other energy companies, they're going to be great turnaround plays, right? Because we've seen demand for oil collapse. Now it's slowly starting to come back. The price of oil is slowly starting to stabilize. But back a couple months ago, once the CV hit, it spread like wildfire. A lot of people weren't traveling. They weren't going out. They weren't doing this, that, the third. And that held back a lot of these oil companies. Their stocks collapsed because the price of oil collapsed, and they weren't making as much money as they were back when demand for oil was at its peak, right? So at this point in time, we're seeing ExxonMobil recover a bit. I mean, it's gone from $56 to $31, so it went down almost 50%, 45% to be exact. And ever since that low point from about $30, middle towards the end of October 2020, it's been rallying pretty aggressively as we're getting the V shot from Pfizer, Moderna, right? You guys know what I'm talking about. This is instilling a lot of confidence back into the consumer, and as this is widely rolled out, the V shot that is, I believe more and more people are obviously going to feel more comfortable traveling, going out, taking a plane, taking a cruise ship, which all of these take up a lot of oil. So moving forward the next couple months, year or two, I see the trend for energy, for oil consumption to go up. I see it recovering, and Exxon is very well positioned to take advantage of this. And not only is it a turnaround play, we might get some nice price appreciation on this stock, it is also a very hefty dividend payer. It pays a nice juicy dividend of 8.14%, and it has an annual payout yield or dividend. It pays about $3.50 annually to its shareholder. So that means if you have one share of Exxon, let's say you have one share, you buy it now for $41. In the next year, you're going to be getting about $3.50 from dividends. Again, pure passive income. You're not doing anything to get this money other than simply owning the stock. And it has a 4.9% 5-year compounded annual growth rate, which simply means it's growing its dividend about 5% year over year, which is good. Me personally, the general rule of thumb here is I like seeing the dividend being increased more than what inflation is. Inflation at this point is what? 2%, 2.5%. So I like to see my dividend growing more than inflation. In fact, a lot more than inflation. And in this case, we're growing about 2 times inflation, which is pretty solid. And some of the other stocks we'll go into here in a little bit, they're even more than a 5% 5-year CAGR. And they also have paid a dividend 38 years in a row, making ExxonMobil a dividend aristocrat. And a dividend aristocrat, you may ask, is simply a company that has grown its dividend for 25 plus years. And a company that's grown its dividend for 50 plus years, we'll get into one of those in a little bit here, is considered a dividend king. So ExxonMobil, very strong dividend. It's a turnaround play here as oil is stabilizing. If you guys remember, I think it was in May, we saw oil contracts go negative. I believe that's the lowest they've gotten ever, if I'm not mistaken. So it was a pretty interesting time for oil back then. But again, now it's stabilizing. We see crude oil at about $50 a barrel. So this is a pretty good price for these oil companies to make money, for their profits to stabilize, their earnings to stabilize, and a higher price in crude oil is even better. So number one stock here is ExxonMobil, ticker symbol XOM. And full transparency, guys, I own all of these stocks except for one. The one that I don't own is stock number 2, which is Raytheon. And this is one that I'm actually looking to add into my portfolio in 2021, and the time might be right now. I mean, we're seeing a pretty nice dip in Raytheon. It's down from $75 to about $69. That's about an 8% dip, so that could be a nice dip buy on Raytheon. And if you guys don't know what Raytheon is, well, it's an industrial company. It's in the industrial sector under the industry of aerospace and defense. And Raytheon is a corporation. Let's dive deeper into what it actually is, because I know a bunch of you guys out there probably don't know what Raytheon is. So I'm going to read this little bio. Raytheon Technologies is an aerospace and defense company. It provides advanced systems and services for commercial, military, and government customers worldwide. It operates in 4 businesses: Collins Aerospace Systems, Pratt & Whitney, Raytheon Intelligence and Space, and Raytheon Missiles and Defense. The Collins Aerospace System business offers aerostructures, avionics, interiors, mechanical systems, mission systems, and power and control systems that serve customers in the commercial, regional, business, aviation, and military sectors. The Pratt & Whitney business designs, manufactures, and services aircraft engines and auxiliary power systems for commercial, military, and business aircrafts. The Raytheon Intelligence and Space business engages in developing various sensors, training, and cyber and software solutions, and the Raytheon Missiles and Defense business produces a portfolio of advanced technologies, including air and missile defense systems, precision weapons, radars, and command and control systems that delivers end-to-end solutions to detect, track, and engage threats. So if you want some exposure to aerospace, defense, maybe you don't have much industrials exposure at all, Raytheon, ticker symbol RTX, could definitely be one to look deeper into. And mind you guys, these are not stocks that you should just watch this video and go buy them. It's very important that you do your own research, you do your own due diligence before buying any of these stocks. And when it comes down to RTX's dividend, it pays a 2.7% dividend yield. So it's not as much, nearly as much as Exxon's 8.14%, but it's not bad. 2.7%, right? It's paying out a $1.9 or $1.90 annual payout. So if you have one share of Raytheon, you're getting about $2 a year in dividends, and they actually have a 62.51% payout ratio, meaning they're paying about 60% of their earnings to shareholders in dividends. So that's a pretty healthy spot, 50, 60, 70% payout ratio. And their 5-year compounded annual growth rate, we'll just call it CAGR, right? CAGR, is 4.5%, which, just like ExxonMobil, that is also beating inflation, which is nice. And also like ExxonMobil, Raytheon is a dividend aristocrat, having grown its dividend for 27 years in a row. So that's stock number 2, Raytheon Tech, ticker symbol RTX. So stock number 3 is ticker symbol PG, also known as good old Procter & Gamble. This is in the sector of consumer staples, and it's a household and personal products type of business. It operates in 5 segments: beauty, grooming, healthcare, and fabric and home care, as well as baby and feminine and family care. So a lot of different consumer staples, a lot of different segments, a lot of different products that are essential to you and to me is what Procter & Gamble sells, right? Some of these main products are Pampers, Tide, Gain, Bounty, Charmin, Gillette, Head & Shoulders, Old Spice, Pantene, Cascade, and there's literally so many more on top of that. There's a lot of products, right? A ton of products that Procter & Gamble sells. I mean, if you guys go and look in your bathroom or in your kitchen and you go and look at your kitchen cleaning products or whatever, I guarantee you, if you look on the bottom at the label, it's going to say Procter & Gamble on one or many of the products that you already have in your house. And I bet you don't even know that Procter & Gamble is actually behind these products. So in terms of their dividend, and by the way, guys, again, I own all of these stocks except for Raytheon. This is one that I've owned for a while at this point. Their dividend, Procter & Gamble, is 2.27%, a payout ratio of 56.7%, so they're paying about half of their earnings in dividends with a $3.16 annual payout. So if you own one share of Procter & Gamble, you're getting about $3 a year, $3.16, and they have a 3.13% 5-year compounded annual growth rate. So that's not the best. I'll be honest, they're not growing their dividend too quickly, but they're paying a pretty safe dividend nonetheless, which is why I own Procter & Gamble. And they're not a dividend aristocrat. No. They're a dividend king, guys. They've grown their dividend for 64 years in a row, which is absolutely unbelievable. So Procter & Gamble is a great business, very safe, very, very nice for cash flow. And mind you, guys, none of these businesses here are going to get you rich in the next couple years. That's not the point. They're not growth stocks. They're not NEO. They're not Tesla. They're not some of these crazy NNDM, Nano Dimension. They're not some of these companies that can 5x in terms of capital appreciation. That's not the point. They're companies that pay dividends, which you can then put back into the companies, buy more stock with the dividends you accumulate, and take advantage of compound interest. So maybe in 10 years, 15 years from now, you're like, crap, I've built this awesome dividend portfolio where I'm getting $2,000 a month. I'm getting $3,000 a month, which could actually supplement my income. And maybe even you can live completely off of the dividends. That's the point. You're not really looking for a 10x stock here. You're more looking for safe, stable cash flow that you can live off of one day. That's the point, or at least that's the point for me, right? And let me know your thoughts down below in the comments. But stock number 4 is AbbVie, ticker symbol ABB. This is one that's been on fire. I've been buying this one the past year. Pretty much every month I've been dollar cost averaging, maybe even over a year at this point. And they're in the healthcare sector. They're a drug manufacturer, and some of their products include Humira, Rinvoq, Androgel. They have a bunch of products out there, a bunch of drugs that maybe you don't know. I don't even know all of them, but their main ones are Humira, Rinvoq, Androgel, a bunch of other ones, and they actually have a ridiculously quick growing dividend. They pay about a 5% dividend yield right now. They pay about $5.20 annually. So for one share of AbbVie, you get about $5 a year, which is great. And they have a 50% payout ratio. Half of their earnings are going to dividends, which is great. And get this, guys, they're growing their dividend. Their 5-year CAGR, compounded annual growth rate, is 21%. So they're growing their dividend 21%, which is by far the quickest growing dividend here. And that vastly outpaces inflation, which I'm very happy about. And they've only grown their dividend for 7 years. So they're not one of these Procter & Gamble's, Exxon's, Raytheon's that have well over 25 years of growth. They only have 7 years of growth, but still, there's a lot of potential in my opinion. So that's stock number 4, AbbVie. Take a look at this one, guys. Very awesome for cash flow. And the last one here is good old Johnson & Johnson, guys. Ticker symbol J&J. And Johnson & Johnson, for those of you guys that don't know, is a healthcare company, right? They research and develop, they manufacture, and they sell various products in the healthcare field worldwide. They operate in 3 segments: consumer, pharmaceutical, and medical devices. Some of the key products include, and I bet you own a lot of these, very similar to Procter & Gamble, you own a lot of these, I guarantee it. Some of them are Johnson's Baby, right? Their baby line. If you have babies, you know for sure what the Johnson's baby line is. They have Listerine, they have Aveeno, they have Neutrogena, they have Tylenol, they have Band-Aid, and literally so many more products on top of that. Again, you definitely own at least one of these products in your household, if not multiple of these products. And when it comes down to the dividend, they pay a 2.61% dividend yield. They have about a $4 annual payout. So for one share of J&J, you're getting $4 a year, and they pay out 50% of their earnings in dividends. In other words, their payout ratio is 50%, and their 5-year CAGR is 6.3%. So pretty nice. They're growing their dividend pretty nicely there, 6% over 5 years, compounded annually. And they have a 58-year track record of growing their dividends. In other words, 58 years in a row of dividend growth, which puts them in the category, same as Procter & Gamble, of dividend kings. So that's pretty much it, guys. We have Johnson & Johnson, we have AbbVie, we have Procter & Gamble, we have Raytheon, and we have Exxon. These are 5 different companies in different industries, different sectors that I'm looking to buy a lot more of in 2021 to really take advantage of pure passive income, to really be able to maybe one day supplement my income with some good old dividends, which again, it's the easiest way to make passive income. A lot of people say, oh, go start an online business. Oh, go start this, that, the third. But a lot of the time, all of those take a lot of upfront work and a lot of ongoing work, which is not passive. The truest form, again, is simply buying a stock and getting paid every quarter their dividend. That's the easiest way to make passive income in 2021 from dividend stocks. So I hope you all enjoyed the video. Make sure to leave me a comment down below. Do you own any of these stocks? Are you looking to buy these stocks in 2021? And if you guys enjoyed the video, make sure to hit the like button, subscribe to the channel, and also join the Strive Smart Discord chat, the Strive Smart Facebook group, and get yourself some free stocks. All of those are linked down below, and they're free of charge. Everything is free of charge, linked down below. So I'll catch you all in the next video. Thanks for watching as always. Stay safe out there. Keep crushing the markets. Peace out.